Namaste. In this video, we'll discuss about NDS 102 that talks about share-based payments. So, objective of NDS 102 is to prescribe how an entity should account for the share-based payment transaction in its financial statement. So, now question arises: what is share-based payment transaction? So, it is a transaction where entity receives goods and services, and consideration against these received goods and services are settled either by equity instrument of the entity, it may be in form of shares, options, etc., or entity provides an option to the service provider that it will be paid in cash. Amount of that will be based on the price or value of the equity instrument. So there are two options. One option is that against the goods and services that entity has received, it will be paying against issuing on equity, or it will pay in cash, but the cash price will be based on the price of the equity instrument. So the main mandate of this NDS is to booking the expense in profit and loss account and corresponding second impact in the financial position, that is called balance sheet. So this applies even if there is a no cash outflow of the entity, because if it is issuing the equity or options, shares, etc., in that case there is no cash outflow, but we need to book in P&L as an expense, and correspondingly we need to book the another impact in the financial position. For example, in case of employee share options, the company grants share option to the employee at, as part of remuneration, and employee render services over the vesting period. So, accounting implication that company must recognize employee expense in P&L, and it should increase the equity, that is share based payment reserve that it has to issue. So, even though there is no cash in this transaction at the grant day, we need to book expense also as well as the equity portion also. Next is, it is there are three types of transactions. So it will be first is equity settle, where ESOPs are granted to the employees and expenses recognized, and side by side equity is increased. Second is cash settled transactions, where payment is made based on the price of the equity on a particular date. Third option is choice settled transaction, in which employee can choose either cash payout or shares at the vesting date. So there are three options. Those will be covered under Ind AS 102. And in case, even if goods and services are not identifiable, clearly identifiable, in that case also Ind AS 102 still applies if circumstances indicate that goods and services have been or will be received. You can't see or separately identify the exact goods and services, but we have to pay for it. What may be the cases? For example, the employee loyalty or future efforts. This is something that we cannot see and measure reliably. But if we are paying for it, we need to recognize for it. And Ind AS 102 applies even when settlement is done by another group entity or the shareholders. For example, parent company grants ESOP to the employee of the subsidiary, and subsidiary receives employee services. So subsidy need to apply Ind AS 102. And there are some exclusions that shareholder capacity transactions are excluded if those offers are issued to the all shareholders. In that case, the employees, although those are employee of the company as well as the shareholders, will be excluded. And business combination consideration are excluded, and goods and services received under contract covered by financial instruments, for example 32 and 109, are also excluded. And fair value will be measured as per Ind AS 102. It will be not as per another index. Next question is regarding the timing of the recognition. An entity will recognize goods and services received in a share-based transaction when goods are obtained, or in case of services when services are received. So correspondingly, based on the receipt of the goods and mode of the payment, whether it is a equity settled transaction or cash settled transactions, the transaction will recognition will differ. For example, in case of equity equity settled share based payment, we need to recognize expense or assets as the case may be, and correspondingly we need to increase the equity. And in case where there is a cash settled share based payment, in this case debit side will be the same. We need to recognize expense or the asset based on the nature of the transaction, and we need to correspondingly book the liability. In the first case we have booked it in the equity, but in case of the cash settled transaction we need to book it in liability side, and we need to remeasure it subsequently on yearly basis. So in an equity settled share based payment transaction, the entity shall measure goods and services received and correspondingly will increase in the equity. So primary rule is that measure directly at the fair value of the goods and services received and book it in the equity. So, but there is a one exception to this, that if fair value of the goods and services cannot be estimated reliably, in that case we need to measure indirectly by reference to the fair value of the equity instrument that we have granted. Similar rule applies for the employees also. In case of the employees, as the services provided by the employee cannot be measured reliably, so we need to give reference to the fair value of the equity instrument granted. So there is an exception to the main rule, that first we have to measure the fair value of the goods and services received. If it cannot be measured reliably, then we need to check for the fair value of the equity instrument issue, but it will be in the rare cases. But it is normal in case of the employees, that employees services we cannot measure reliably value of that, so we need to look for the fair value of the equity instrument granted. And in the first case, the measurement is on the date when goods and services are received, but in case of the employees it is on the grant date when employee is eligible for the instrument, when yes, when the scheme is announced. And in case of non-employee transactions, there is a reputable assumption, it will be apply only in rare case, that if entity reviewed the presumption that fair value cannot be estimated reliably, then we need to take reference to the fair value of equity instrument, but it will be on the date when goods and services are received. It will not be on grant date. Grant date is only in case of the employees also. So if we summarize, in case of the employees, the measurement basis will be the equity instrument and the measurement date will be grant date. In case of non-employees, it will be the date on which the goods and services are received. And in case of non-employees, it will be equity instrument, and but the date will be the receipt of goods and services. Next is in case of hidden unidentifiable goods and services. So there may be situation where fair value of the equity instrument exceeds the fair value of goods and services received. So what does it indicate? It indicates that equity entity has received some unidentifiable goods and services, or it may receive the unidentifiable goods and services in the future. So we need how the question arises, how to account for it. So first we need to check for the identifiable goods. So in case of identifiable goods and services, we need to measure as per the normal Ind AS 102 rule, that is at their fair value. Then we need to measure the total consideration, that is the fair value of equity instrument granted or liability that we have incurred. So in this case, now we need to check for the difference amount. So we need to deduct the value of the identifiable goods and services from the fair value of the equity instrument that we have granted. And the difference will be treated as a payment for unidentifiable goods and services. So what will be the recognition timing? So for the identifiable goods, it will be recognized when they are received. Unidentifiable services, it will be recognized as and when they are received over the vesting period or immediately if they have already been received. So let's take one example. For example, consultant pay partially for unidentifiable services. Facts share granted fair value is 10 lakhs and consultant provide a report. The fair value of that report is 6 lakhs. So the identifiable goods are 6 lakhs and excess that we have paid is 4 lakhs. So the extra 4 lakhs indicate that unidentifiable services such as strategic brand advice, maybe strategic advice, brand value or market access may be there. So in this case, we need to book 6 lakhs as a consultancy fees and 4 lakhs as employee or consultation services as the case may be, and we need to increase the equity by 10 lakhs. So this will be the treatment of hidden or unidentifiable goods and services. Next, we discuss the transaction in which services are received. So first is immediate vesting of equity instruments. Equity instruments vest immediately when counterparty is not required to complete any future services, or entitlement to equity instrument is unconditional at the grant date. So in this case, accounting presume that entity has already provided the services and on the grant date, we need to recognize full value of the services received and need to credit equity in the full. In case of, so for example, share granted to an employee with no service condition. On the grant date, he is eligible for the share. So in this case, we need to book entire employee compensation recognition on the grant date, employee expenses, and correspondingly, we need to increase the equity. And so first case was the immediate vesting. Second case is deferred vesting. Or if there is a service condition attached to the instrument that is issued. So in this case, equity instrument do not vest immediately and vesting is conditional upon completion of specified services period, maybe 2 years, 3 years, 5 years, etc. And there may be fulfillment of performance obligation also. So in this case, accounting presume that entity the services will be received in future over the vesting period. So on proportionate basis, the expense to be booked. So in this case, we need to recognize employee compensation over the vesting period with corresponding increase in the equity. Further, there may be performance conditions with the variable vesting period. For example, share option vest when a performance condition is achieved or employee remain in the service until the achievement. So there may be two conditions attached. Performance also and employee need to remain in the service till the achievement. So here in case vesting period is not fixed, it depends on when condition is satisfied. So in this case, as entity shall estimate the expected vesting period at the grant date, how much time it will take to achieve the transaction. Based on that assessment of vesting period, we need to book the expense over expected variable vesting period. So with this performance conditions, there may be two type of performance condition. One is the market condition. Market condition are those are related to the market. Entity has nothing to do with it. For example, share price reaching on a specific level. So in this case, we need to expect vesting period. We need to estimate it, and it may must be consistent with the assumption used in option valuation, and no subsequent revision is allowed in case of market conditions. So if there is a market condition, we need to estimate once and we are not supposed to revise it further. But in case of non-market conditions, for example, revenue targets and production output, etc., we need to expect vesting period. We need to estimate expected vesting period and we need to revise it necessary. In case of market condition, revision is not allowed. But in case of the non-market condition, we are supposed to revise the estimated vesting period, and based on the updated information, we need to revise it. So in case of non-marketing market condition, we need to revise if estimate related factors to required for vesting changes. So we need to require accordingly the period also. So ultimate memory formula is, if the uncertainty is the price, we are not supposed to revise. But if the uncertainty is about the service, we are supposed to revise it. So let's take few examples. ABC Limited granted to its employees share options with a fair value of 5 lakhs on April X0 if they remain in organization up to X3. The exercise price of the share is nil. Share option is nil. On March X1, ABC Limited expected only 91% of the employees to remain in employment. On March X2, company expect that only 89% of the employees to remain in employment. However, only 82% of the employee remained in the organization at the end of X3. All of them exercise their options. Share options will be settled in 5,000 shares of 100 each. So number of shares are fixed. So the vesting period in this case is 3 years. And the probability is also given. In first year it is 91%. Employees will opt, and in second year 89%, and the third year 82%. So and fair value is 5 lakhs. So proportionately we need to book the expenses in all 3 years, 1 by 3, 2 by 3 and 3 by 3, subjected to the probability. So 5 lakhs into 91% into 1 by 3, it will be 1,51,667. And in second year it will be 2,96,667, out of which 1,51,667 we have already booked. So remaining amount 1,45,000 we will book in second year. And in third year, 5 lakhs into 82%, the amount comes 4,10,000. Out of this we will reduce the amount that we have already booked. So remaining amount will be 1,13,333. So total expense that we will book in 3 years will be 4,10,000. So let's look at the accounting entries. In the first year, we will book employees benefit expenses, debit to share based payment reserve 1,51,000 that we calculated here, and next year we will book 1,45,000, same entry. Third year we will book 1,13,333, this much. So total amount that was booked in share based payment reserve in 3 years was 4,10,000. This will be, we will transfer to share capital or security premium account. Next is about measurement by reference to the fair value of the equity instrument. So when this section applies, this section applies only when the goods and services cannot be measured reliably, and transaction is therefore measured by the reference to the fair value of the instrument that has been granted. So if services are not measurable, then we have to look for the shares. And in this case, rules are that fair value of equity instrument shall be measured at the measurement date. No, and for employees, it is the grant date. And measurement shall be based on the market price if available. And we need to do some adjustment based on the share conditions. So market price must be considered after adjusting for the terms and condition of the grant, such as the vesting period and the exercise period restrictions and transferability restrictions, whatever attached to the instrument that it has been issued. So first we need to look for the market price available. If it is available, then we need to use observed market price for the equity instrument, and we need to adjust it for the grant specific features. And in case the market price is not available, in that case we need to use the valuation techniques. Next is vesting conditions. Vesting conditions may be the service conditions. For example, employee has to remain in service for 3 years. It may be related to the performance condition also, which may be that market condition, share price target, that share price should reach at 500 rupees, or it should increase by 50% or 200% like this. And there may be non-market conditions also, that profit growth should be there, revenue target, etc. Those are directly linked with the performance of the employees and the organization. So there are two broad categories of the vesting conditions, and treatment also depends on the nature of vesting condition. So it is important to understand. First is the non-marketing market vesting condition. So non-market vesting conditions, as we have discussed, are related to the performance of employee and the organization. So in this case, we need to adjust the number of equity instrument expected to vest and not to the fair value of the instrument, as we have solved one question where we change the number of equity instrument, not the grant. So in this case, we need to adjust the number of equity instrument that we are supposed to provide to the employees. And in case if the equity instrument do not vest due to failure of non-market vesting condition, we are not supposed to recognize expense, because it is considered that services has not been received, because we have failed to achieve the target. So on a cumulative basis, if vesting fails, then previously recognized expense is reversed. So what is the estimation revision mechanism? During vesting period, entity shall recognize expense based on the best available estimate of the equity instrument expected to be vest, and this estimate should be revised on yearly basis. Next is the market condition. The key rule is that market conditions are considered in estimating the fair value at the grant date. Whatever fair value we have provided, all the conditions up and downs have been considered while calculating the grant fair value at the grant date. So recognition principle is entity will recognize the goods and services if all the vesting conditions are satisfied, but it will not consider the market condition for recognition of expense. It will look only for the vesting conditions, not the market conditions, because market conditions, failure, etc., we have already taken care in the fair value, and whatever services we have received, it will not be reversed. So we have to book the expense. So here, because market condition are already priced in, failure to meet market condition does not reverse the expenses. So this is the basic difference between two conditions. Non-market vesting condition, we need to revise the estimation, increase the period, change the expense based on the achievement or non-achievement. We have option to reverse the expense that we have already booked. But in case of the market condition, if there is a failure to achieve because of the market condition, there is no option to reverse the expense. Next is reload feature. So what is reload? Reload means when an employee exercise option and enterprises entity provides him additional option as consequences of exercising the previous option. So it is directly linked with exercising the existing shares, or it is an incentive to remain in employment. So core accounting is that reload feature shall not be considered when estimating the fair value of option granted at the grant date. But reload feature is treated as a new option only if and when the reload option is actually granted. So at that time, it means that when the option reload option is granted, it will not be considered for the accounting, but it will be considered for accounting at the time when the reload feature is actually exercised. For example, there is a condition to be remain in service for 5 years, and after 5 years, you are also eligible for the reload feature, additional options. So additional options will be booked at the time when the employee is eligible after 5 years. So now question arises, why reload feature is ignored at the grant date? So first reason is that condition reload feature is conditional and is uncertain. It depends on the future employee action, whether he will exercise it or not at the grant date, and it is not certain whether reload will arise or not. Second is, because of this uncertainty, it will result on faithful representation also. If we include the reload feature upfront, then it will overstate the fair value of the original grant. And Ind AS 102 follows the substance over speculation. That's why it is not considered. For example, an employee granted 1000 options. On exercise, he will receive 2000 reload option also. So accounting treatment at the original date, we will consider only the original option and we will ignore the reload possibility. When reload options are granted, we will account for as a fresh grant. Next is accounting after the vesting date. So core principle is that once the vesting is closes, accounting chapter is closed. So for example, once the goods and services have been recognized under equity settled share-based payment and instrument have been vested, then no subsequent adjustment is permitted in the equity. So core rule is that vesting closes the accounting chapter. No subsequent adjustment means that entity will not reverse the expenses that it has been recognized and corresponding increase in the equity. Even if vested equity instruments are later forfeited or options are not exercised, once it has been vested, there is no option to change it. So why conceptual logic that why there is no reversal? Reason one is services has been already received. Vesting confirms that the entity has taken the benefits of the services. Employee have fulfilled the all vesting conditions and entity has obtained the economic benefits. So there is should not be any reversal. Reason two is post vesting events are equity holders decision whether he opt for the options or not. So it is not that entity has not the obligation. Entity has the obligation. Now it is on part of the employee whether he opt for that option or not. So because of that, it cannot be reversed. But there is one important clarification that transfer within the equity is allowed. While total equity cannot be adjusted. For example, employees have not opt for the options. So if they have not opt for the options, the expense part that we have recognized cannot be reversed, but the liability part, that equities are not issued. So we can transfer that unissued equity part to the different equity component. Next is when fair value of equity instrument cannot be estimated rarely, but it is an exception, not the rule, and will be applied only in rare cases. So if the fair value is not measurable, in that case, we need to switch to the intrinsic value method. What is the intrinsic value? It is value of an option, market price of the share minus the exercise price. If positive, then it is okay. Otherwise, it will be called zero. So what is the measurement mechanism under intrinsic value method? First, we need to measure at the intrinsic value at the date entity receive the goods and counterparty renders the services. Subsequently, we need to remeasure intrinsic value at each reporting date and at the final settlement date. And accounting impact is that all changes in intrinsic value are to be recognized in profit and loss account. So recognition of goods and services, key principle is the goods and services are recognized based on the number of equity instrument that ultimately vested or are exercised. And we need to recognize the expense as the services are rendered and based on the expected number of options to be vested. So here we need to estimate the revision. Entity must revise estimate if exception change on the vesting date or true up to the actual number vested. So there is a difference between the normal equity settle accounting. Here, market conditions rule do not apply. As in earlier cases, we have recognized that if the market conditions have not been fulfilled, we need to book the expense. Here, the rule has been ignored, and intrinsic value method already reflect the market movement directly. It is considered. Next is regarding the modification, cancellation, and settlement. So in the options, entity may modify the excise price, vesting conditions, or other terms of the equity. So in this case, and these modifications apply for the employees as well as for the non-employees also. And in case of non-employees, we consider the date goods are received or services are rendered. So there is one minimum recognition rule that entity shall recognize at minimum the service received measured at original grant date. So whatever we have measured, whatever services we have received, we need to measure at the original grant date fair value. Unless equity instrument do not vest due to failure of non-market vesting condition. If it is fails due to non-market condition, there is no reason to recognize it. But in case it fails, in case of recognition, we need to consider the original grant date fair value. So what does it mean? That even if options are repriced, terms are changed, grant is cancelled or settled, entity cannot reduce expense below the amount that has been determined at the original grant date. So whatever we have recognized, we have announced, we need to book the expense based on that, whatever fair value was there on the grant date. But if there is a modification that increase the total fair value and is otherwise beneficial to the employees, then the incremental fair value we need to recognize. So the incremental fair value we need to recognize over the remaining vesting period. For example, there is repricing options, lower excise price. So original fair value, grant fair value we must recognize, and we need to increase the fair value due to repricing, and we need to recognize it additionally. In case of cancellation or settlement during the vesting period, applies when cancellation is not due to the forfeiture because of the any other reason other than the forfeiture. So first is the acceleration of the vesting. In case of the cancellation, it is treated acceleration of vesting and immediately all the expenses related to that scheme is recognized. And if there is a payment on the cancellation to the employees, we need to treat it as a repurchase of the equity. So we need to deduct from the equity and excess whatever we have paid. We need to recognize it as expenses. For example, equity portion was 10, but we have paid 110. So 10 we will reduce from the equity and 10 we will book as an expense. In case of the liability component, if award has a liability component, so in case of liability, we need to remeasure liability at cancellation date and we need to adjust the liability with the payment. In case of replacement of the award, when the replacement is identified, in that case, new equity instrument granted as replacement for cancelled one. And in this case, we need to treat as a modification, not a new grant. And we need to recognize originally grant value minimum that we as we have discussed in previous slide, and we need to book incremental fair value. What is incremental fair value? It is the fair value of replacement instrument minus the fair value of the cancelled instrument. So we need to recognize the additional, we need to keep on booking expense based on the original value and the additional amount we need to vest in the remaining period. And if replacement is not identifiable, then we need to book it as a fresh grant. If non-vesting conditions are not met, for example, if entity or counterparty choose not to meet a non-vesting condition, then such failure is treated as cancellation. And as we have discussed, it will be considered as accelerating vesting and recognizing remaining expenses immediately. Logic behind it is that a controllable failure is economically equivalent to the cancellation. And in case of repurchase of vested equity instrument, it is deducted from equity. And whatever excess we have paid, we need to book as a expense. So here buyback hits the equity and whatever excess we have paid, we consider it to hit at PL. So we have discussed equity settled share-based payment. Now second is cash settled share-based payment. So in this case, cash settled share-based payment is entity receive the goods and services. It has an obligation to pay where the amount that is payable is based on the price or value of the equity instrument. Instead of issuing shares, it is paying price to the goods and services based on the price of the equity instrument. So here we need to measure the goods and services received and we need to book the corresponding liability at the fair value of the liability. So the most critical rule here is that until the settlement of liability is done, we need to remeasure the liability at fair value at each reporting date. And the difference we need to book in the P&L because my payment is based on the price of the share, whether it increase or decrease. At the settlement date, I'll pay to the supplier the based on the share price that exists. So why remeasurement is required? Because entity has a present obligation to pay cash. Cash obligation, it fluctuates with the share price. If share price increase, my liability to pay to the customer increase, supplier increase. If it decrease, my liability also decrease. Hence, liability must reflect the current fair value, not the historical value. And in case there is an immediate vesting, for example, SAR, share applications rights. If vest immediately, no future service requirement, in that case, we need to presume that services has already received and we need to recognize expense and liability immediately. And in case of deferred vesting service period, if SARS vest After the specified period, service presumed to be received over the vesting period, and accordingly we need to recognize expense and liability as the services are rendered. And measurement of liability, it is measured at fair value initially, and each reporting date we need to book it till the settlement date. So again, vesting and non-vesting conditions in cash settle award. Why it is different? Because in cash settle share-based payment, the obligation is liability, not equity. Hence, liability is remeasured. In equity settle, we have not remeasured the liability. We only adjusted the number of the shares to be vested. But here, because the obligation is liability and it is based on the share price, we need to remeasure it. So therefore, treatment of condition must ensure that full final cumulative expense is equal to the actually cash that we have paid. So treatment of vesting conditions for non-marketing market vesting condition, it is not included in estimating the fair value of the liability. Instead, they are reflected by adjusting the number of awards. And for recognition and revision, during vesting period, entity will recognize expense and liability as services are rendered, and amount recognized is based on the best estimate of the awards expected to vest. And where there is a revision requirement, we must revise whenever new information is available, and on vesting date estimated is trued up to the awards that actually paid. So this mirrors the equity settle logic. It is similar to that, and difference lies only in the remeasurement of the liability, because the number of liability increase, no, amount of liability increase based on the value of the shares, but not in the equity settle plan. So for the treatment of market conditions, key rule is that market conditions are included in the fair value estimation at the grant date and fair value remeasurement at each reporting date at the settlement. And why market conditions are included? Because they affect the value of cash obligation, and since the liability is remeasured each period, market movement must be captured continuously. Next is, there may be cases where net settlement is done. Government required entity to withhold the number of shares against the tax liability. So what we need to do? So under why this issue arise? Because under tax laws, employer may be obliged to withhold the tax on share-based payment to the employees, and to fulfill this obligation, entity may withhold a portion of equity instrument that would otherwise be issued. So instead of issuing all the shares to the employees, they hold some shares to the equivalent to the tax liability, and equivalent cash is paid to the tax authority. So this arrangement is called net settlement feature, and whether it will be equity or cash settled, so we need to understand it. General rule is that if an entity has an obligation to pay cash, it is considered cash settled. But there is an exception to this rule, that despite the cash payment to the tax authority, this transaction is classified as equity settled if it would have been equity settled in absence of net settlement feature. So because of the cash payment to the government authorities, it is not considered as a cash settled transaction. It will be still considered equity settled transaction if the original transaction without considering a net feature is classified as a equity settled transaction. So why this exception exists? Because the cash payment is not reimbursement, the remuneration to the employee, but it is merely a statutory tax withholding. So employee compensation is still called equity settled. So how is the cash payment treated? So it will be paid to the tax authorities and accounted as deduction from the equity. Except any amount paid in the excess of the fair value of the shares within, it will be recognized in profit and loss account. So conceptual logic is the entity is effectively buying back its own shares to settle tax obligations. So limits of the exception is that equity settle exception does not apply in the following cases. There is a Okay, this exception does not apply in the cases where there is no legal obligation to withhold the tax. It applies only where there is a legal obligation. If entity is not required under tax laws to withhold the tax, but still settle part of the award in cash, in that case, the portion is cash settled, not equity settled. So this exception will be apply only if there is an obligation to withhold tax by the tax authorities. So only essentially withholding qualifies for the special treatment and excess share withheld. If entity withholds share exceeding the employee's actual tax obligation, then excess portion is not covered by the exception and accounting treatment excess shares withheld, it will be treated as a cash settled share based payment when cash is paid to the employees. So what are the cash alternative? These are the share-based payment arrangement where settlement can be made either in cash or by issuing the equipment. And the choice lies with the entity or counterparty. So here is something where entity gives an option to the employees, either you take the shares or you take the cash. So now the option lies with either the entity or with the employer or supplier how to settle the transaction. So there is a specific nature of mixed blend nature of transaction. So here the core classification principle is the entity shall account for the transaction as cash settled to the extent the liability exists, and it will be booked as a equity settled to the extent no liability exists. So here the to the extent word is very important. Single arrangement may contain liability component also and equity component also, and each component we need to identify it and accounted separately. So memory is we need to split the transaction if the obligation is split. So first is the alternative where the counterparty has the choice, employee or the provider of service has the choice what we need to do. So when the counterparty has the right to choose cash or equity instrument, in that case, entity has issued a compound financial instrument that consists two components. One is the debt component. Debt component consists the part that counterparty's right to demand cash and we need to create a liability. Second component is called equity component where counterparty's right to demand equity instrument instead of cash. So it's a employee choice, debt or equity or together. So next is how to measure transaction with parties other than employees. If the fair value of goods and services is measured directly, so we need to find out the equity component. So to find out the equity component, it is equal to the fair value of goods and services that we have received minus the fair value of the debt component. And measurement date will be the date on which grant is received. And in case of the transaction with the employees, as the fair value of the goods and services cannot be measured directly, so in this case we need to measure the entire compound instrument at measurement date, and it will be measured based on the terms and condition of the both settlement alternative. So in the first case where it is transaction is not with the employees, so in that case we need to first measure the goods and services, and after that we need to reduce the debt component to find out the equity component. But in this case we need to find out the value of entire compound instrument. So in case of non-employees, we need to split from the service, and from the employee perspective, we need to split from the instrument value. This is the difference. So next is, first step is we need to measure the debt component. Fair value of cash settled alternative as if the award was purely cash settled. First, we need to find out what will be the value if only cash is demanded. And after that, we need to find out the equity component. We need to measure the fair value of compound instrument, and out of that, we need to reduce the debt component value. So often cash alternative and equity alternative have equal value, but in such case, the equity component value is zero and entire value is be considered as debt component. So debt first, equity is residual. Next is accounting during vesting or service period. The entity must account separately for each component, debt component also and equity component. So for debt component, we need to recognize the expense and liability as the services are rendered, and liability must be remeasured at the fair value. In remeasurement is because the liability will increase. It is based on the actual price. And in case of the equity component, we need to recognize the expense and increase the equity based on the grant date fair value, and there is no remeasurement after the grant date. So liability moves every year, equity freezes at the grant. So accounting at the settlement date will be, we need to remeasure liability to fair value, and if equity instrument are issued, we need to transfer liability directly to equity because liability becomes the consideration for the equity issued. So cash obligation converts into equity on the share settlement date. And if settlement is in cash, so when the cash is paid, we need to settle the liability full, and equity components will remain in equity. It will not be reversed because by choosing the cash, counterparty forfeits the equity alternative, but the entity has already received the services, so it will not change it. It can change within the, it can transfer within equity. Next is when entity has an obligation, entity has choice of settlement. So we need to check, does entity has present obligation to settle in cash? So classification does not depend merely on the wording of the contract, but on the substance. We need to check the substance of the transaction. And entity must assess whether the cash settlement is unavoidable in practice. So to check this, we need to check whether equity settlement has no commercial substance. If no commercial substance means that entity is legally prohibited from issuing shares and shares cannot be issued due to regulatory or commercial restrictions. So it will be considered as that entity has obligation to pay in cash. So next is if there has been past practice of settling similar awards in cash, then also it will be considered as obligation to settle in cash. And if entity has declared policy to settle in cash, or entity generally settle in cash whenever the counterparty requests the cash. So in all these cases, it will be considered as a present obligation to settle in cash. So in this case, key implication is that we need to recognize the liability. Again, we need to remeasure it, and whatever change is there, we need to book in profit and loss account. And if there is a no obligation to settle in cash, in that case, we need to account for the transaction as equity settled share based payment, and we need to recognize equity, not liability, and no measurement is done after the grant date. And in case of accounting at grant date, once classified as equity settled, the following rule will be applied as settlement. In case of entity lets to settle in cash, Cash payment is treated as repurchase of an equity interest, and accounting will deduct cash from the equity and there will be no PL impact. If entity elects to settle by issuing equity, so no further accounting is required except a transfer within the equity if needed, no PL impact. And in case of, there is one exception, higher fair value settlement. If the entity choose the settlement alternative with a higher fair value, so excess value that we have given, it has to be recognized as expense. And if settle in cash, then expense is cash settled minus the fair value of equity instrument that could have been issued. If settled in equity, expense is fair value of equity issued minus the cash that would have been paid. So this is all about the booking of transactions. So let's take few examples about it. XYZ issued 10,000 SARs that vest immediately to the employees on April XGO. The SARs will be settled in cash using an option pricing model. At the date, it is estimated that fair value of SAR is 95. SAR can be exercised at any time up to X3 because these are immediately vested. At the end of the period, it is expected that 95% of employees will exercise the option. Second year, it is expected 92, and in final year, 89% were exercised at the end of the third year. Fair value at the end of each period is given as this, past the journal entry. So fair value at the time of grant was 95. It was expected that 100% will vest. So the value is 9,50,000 because there are 10,000 SARs, 95% value, 100%. And this is cash settled. So we need to remeasure the liability every time. So at the end of the year, value was 112. 95% was vesting. So 10 lakh 64,000 was cumulative figure. 9 lakh 50,000 we have already recognized. So we will book additionally 1 lakh 14,000. At the end of period 3, the value has reduced to 109 and vesting percentage has also reduced 92%. So 109 into 10,000 SARs into 92%. So amount comes to 10 lakhs 2,800. So it is 10,000, 4,000, 10 lakhs 64,000 we have already recognized. So we need to reduce the liability to 10 lakh 2,800. So there will be a gain of 61,000 in expense. And next year the amount has increased to 114 and vesting percentage is 89%. So 10,000 into 114 into 89%, it comes 10 lakh 14,000. So additional amount, earlier amount that we have recognized was 10 lakh 2,800. So additionally 11,800 we will recognize in year 3. So these will be the entry employee expenses 9,50,000 to share based payment liability. At the end of the year, we need to recognize additionally 1,14,000. So expense debit 1,40,000 to share based payment. Then there is a reduction in the liability. So that's why we have reduced the liability account by 64,000 by debiting it, and expense also has been reduced by 61,000. And at the end of the year, the additional amount 1,11,800 to be recognized. So expense debit to liability, and finally the payment liability account debit to cash account. So next is share based payment with cash alternative. So this we have recently discussed. On January X1, ABC Limited gives option to its key employee to take either cash 1,000 or 15,000 equity shares. So minimum services requirement is 2 years, and share based shares being taken must be kept for 3 years. So vesting requirement is only for two years. Share alternative fair value with restriction is 102. So first we need to find out the compound value of the instrument. So equity instrument 1500 into 102, the value is 1,50,000, 53,000. And if they opt for the share, so it will be 1000, and fair value is 110 for the cash without restrictions. So it will be 1,13,000. So the equity option is equity alternative minus cash alternative, that is 40,000, and it will be vested in 2 years, 20,000, 20,000 each. 20,000, 20,000 each, because vesting period is 2 years. But for the cash options, at the end of the year, the value was 120. So 1000 into 120 and divide by 2, because vesting is in 2 years. So 60,000 will be booked in first year. And if we look at the second year, the option was 132. So 1000 shares into 132, it comes 1,32,000, and 60,000 has been already booked. So in next year, 72,000 will be booked. So equity option 20,000, 20,000 each year will be booked. And in cash options, for the cash portion, 60,000 will be booked in first year, and 72,000, 132 minus 60, 72,000 will be booked in next year. So employee benefit expense debit 60,000 to share based payment reserve equity portion 20,000, and share based payment liability 60,000. And next year also it will be booked 20,000 for equity instrument and 72,000 for the liability. So 92,000 will be expensively booked, and share based liability 1,32,000 to the bank if it is settled in cash. And for the equity portion, share based payment amount will be transferred to the retained earning, because option is not exercised. Next is share based payment purchase of the goods. In case of goods, the Indian INC issued 995 shares in the exchange for the purchase of an office building. The title was transferred in name of the Indian INC, and shares were issued. The fair value of the building was 2 lakhs, and the face value of each share was 100. So based on the building, we'll book the building based on the fair value of 2 lakhs and shares issued at the face value, and remaining amount we'll book in security premium account. Next is Reliance Limited hired a maintenance company for its oil field. The services will be settled by issuing 1,000 shares of Reliance. Period for which services is to be provided is 1st April to 1st July. So for 3 months, services to be provided, and they will issue 1,000 shares. So the contract value is 1 lakh. So based on the value of the services that we have received, monthly expense of 33,000 will be booked each and every month. Repair maintenance debit to share based payment reserve equity 33,000. So for 3 months, and after 3 months, share reserve will be debited by 1 lakh, equity share by 10,000, and security premium by remaining 90,000. So here by mistake 10 lakhs is mentioned, it is 10,000. Next is share based payment, where there is an option of cash and equity alternative. So Tata Industries issued share based option to one of its key management personnel, which can be either exercised in cash or equity. Option 1 is number of cash settled shares 74,000, service condition 3 years. Option 2 is number of equity settled transactions 100 with 90,000, service 3 years, restriction to sell 2 years. Fair value is given equity price with restriction of 2 year 115, grant fair value at grant for cash 135, and fair value at end of each year. So here we need to find out the equity component. So first we need to find out the value of compound instrument, that is 90,000 into 115. So it comes around 1 lakh 1 crore 3 lakhs 50,000, and fair value 135 into 74,000. So it comes 99,090. So the fair value of equity component is 1 crore 3 lakhs compound value minus the cash value, it comes 3,30,000, 60,000. So accordingly, expense benefit will be debited based on the shares 1,20,000. It will remain in each year, same amount will be there, but the share based payment liability will keep on changing. At the end of the year, the value was 138, 140, and 147. Similarly, it will keep on changing 138, 147, and we will reduce the earlier amount that we have recognized. Here, when the amount was calculated by 140, the earlier amount we have reduced here. And similarly, here when the 147 based amount is calculated, we have reduced the 30 lakh 4,000, 35 lakh 2,000, both amount to come on the figures. So if the cash alternative is chosen, in this case, the liability will be debited to bank account and the equity reserve will be transferred to the retained earning. But in case of the equity alternative is chosen, in that case, share-based payment liability will be debited to share capital to security premium, and the share-based reserve will be debited to security premium. It will transfer to security premium. So here the direct transfer to the equity from the liability. Next is equity settled non-market condition is there. Ankita Holding grants 100 shares each to employees on X1. The employee should remain in service during the vesting period. The share will vest at end of the first year if company earning is 12%. Second year if company earning increases by 20%. Third year if it is increased by 22%. The fair value per share at the grant date was 1,22,000. 1,22,000 rupees. In X1, earning increased by 10%. Target was 12% and 29 employees left the organization. Company expect that the shares will vest at the end of the X2 second year. Company also expect that additional 31 will leave the organization and 440 will receive their shares at end of X1. At the end of X1, company's retained earning increased by 18%. It still left the target. Company believes that the additional 23 employees will leave in X3 and the earning will further increase so that the performance target in X3 is achieved. At the end of the X3, only 21 employees have left the organization. Assume that the company's earning increased to desired level and performance targets have been met. First, we need to understand, we need to find out whether vesting condition is market condition or non-market condition. Because in this case, the achievement of profit is depending on the performance obligation of the entity and the employees. So it is considered as a non-market condition. And in case of the non-market condition, we need to keep on changing the estimate and to increase or decrease the number of shares that we need to issue. So here the total employees were 500, actual left 29, and we are expecting that 31 will left by end of the next year. And company is saying that by end it expect at end of X1 that by X2 it will achieve the target. So vesting period is considered for 2 years when we are calculating at end of X1. So that's why only 31 employees, those are expected to left in X2, are considered here. So share number of employees at year end expected are 440 and shares per employee 100 and fair value 122. The vesting period here is considered 2 years because we expect that by X2 we will achieve the target. So expense that we will book is 26,084. 440 into 100 into 120 divided by 2 because vesting period is 2 years. At the end of the second year, when we have not achieved the target, management said that company believes that additional 23 will leave and the earning will further increase so that performance target will be achieved in X3. So now the vesting period has become 3. So 500 employees, 50 8 have left, 29 in last year, and 29 have 31. Okay, 29 left in X1 and 29 again left in X2. So total 58 have left and 23 they expect will leave in X3. So 419. So share per value is 120 and the fair value of grant date is 120. So we'll expect that two-third it will achieve in 3 years. So vesting period is considered 3 years. So 7,23,000. 419 into 100 into 120 into 2 divided by 3 because vesting period has increased to 3 years, and 26 lakhs 84,000 we have already recognized. So remaining 7 lakh 23,000 we will recognize in X2. Similarly, for X3 we will recognize 17 lakhs 28,000 based on. So accounting will be employee benefit expense debit to share based payment. Similarly, 2 years for additional amount and in third year for the remaining amount, and the share based payment reserve will be debited and share capital and premium amount will be credited. Next is equity settled non-market condition. So where there is a non-market condition, we are not supposed to change the, sorry, in case of non-market condition, we need to change the amount based on the achievement. ACC Limited granted 10,000 options to one of its manager. In order to get the option, the manager has to work for next 3 years and reduce the cost of production by 10%. Fair value of option is 95%. So 1 year it is achieved. So 10,000 option, fair value of 95,000 and one third amount we have recognized. But in second year, only 8% is achieved and management expect that it will not vest in future. So we will not recognize expense, but whatever we have recognized earlier, we need to reverse it because nothing is going to be paid in future because management expect that it is not going to achieve the target. But in third year, it has achieved. So we have to pay for all 3 years. So amount will be recognized by 9,50,000. Next is the based condition. So in market based condition, we are not supposed to reverse the expense. We need to book the expense. Apple Limited has granted 10,000 share option to one of its director for which he must work for next 3 years. The price of the share will increase by 20% over 3 years. The share price has moved as per the below detail. Year 1, 22%, year 2, 95%, year 3, 25%. At the grant date, the fair value option was 120. How we should recognize the expense? So share price movement is a market-based vesting condition. Hence, the expectation are taken into consideration while calculating the fair value. Even if the required market conditions are not fulfilled, there is no requirement to reverse the expense previously booked. So irrespective of the outcome of the market price, as it has already taken care in the fair value of the option, each period an amount of 120 into 10,000 divided by 3, 4 lakh will be charged to profit and loss account. Next is modification. So we have discussed modification earlier that we need to continue the original value. Original is grant and the differential amount, increased amount we need to book as a additional amount. Marathon Limited issued 150 options to each of 10,000 employees subjected to services of 3 years. Fair value of the option was calculated at 129. Below are the details and activities related to share-based payment plan. 35 employees left and further 60 are expected to leave in year 1. Share option repriced as the fair value fell to 50 and after repricing they are now worth 80 and hence expense is expected to be increased by 30. So number of employees in first year 1000, left 35, expected to leave 30, net employees 10905. Options per employee is 150 and fair value of option is 125. The period weight is 1,50,000, 1 by third. So the expense will be 905 into 150 into 129 divided by 1 by 3. So 58 lakh 37,250. But in year 2, the repricing was done, and hence expense is expected to increase by 30. So employee will get more benefit. So in this case, we need to continue the booking amount, and we need to book additional amount by 30. 899 into 150 into 30 by 1 by 2. And this amount we have changed based on the number of employees also, otherwise amount is more or less same. And in third year, the similar amount will be booked. Original expenses will be booked as it is. Only the figure will change because of the number of the employees, and the additional amount will be booked in the remaining vesting period. Next is cancellation of equity settled base payment. So in case of the cancellation, we have considered that expense will be booked immediately, and additional amount we will book in P&L. So Anara Fertilizer Limited issued 2 lakh 2000 shares to its 10 director for an exercise price of 100. The director are required to stay with the company next 3 years. Fair value of option was 130, and expected numbers of employees was directors were 8. During the second year, there was a crisis in the company, and management decided to cancel the scheme immediately. It was estimated further as below. Fair value of the option at the time of cancellation was 90. Market price at the cancellation was 99. There was a compensation which was paid to director, and only 9 directors were currently in the employment. At the time of cancellation of such a scheme, it was agreed to pay an amount of 95,000, 95 per option to each director. Suggest how the cancellation will be recorded. So in year 1, expected director to vest 8, fair value of option 130, number of option 2000. So and vesting period is 3 years. So one third amount that we have booked was 6,93,000. And in next year, 20 lakh 3 lakh 40,000 will be booked, because 23 lakh 40,000, because the amount has been cancelled, the scheme has been cancelled, so it will be considered as a vested immediately. So 20 lakh lakh 40,000 minus 6 lakh 93,000 that we have already booked, remaining amount will be booked in second year. So amount to be deducted from the equity is 9 directors. Fair value of the option at the cancellation was 90. So total amount 6 lakh 20,000. But we are paying compensation at a price of 95,000. That is higher than the option cancellation date. So additional amount that we are paying 17 lakhs 10,000. That additional amount by deducting after deducting the equity 90,000 will be booked in the P&L. Next is share-based payment among the group entity. So in a separate financial statement, entities receiving goods or services will assess two factors: the nature of award granted, whether it is a cash settle or equity settle, or its own right and obligation not in the groups. So when the receiving entity treat award as an equity settle, the entity receiving goods or services will account for this transaction as equity settle. If either of the is true, that award is being given in its own equity and the entity has no right, no obligation to settle. In this case, settlement lies with the parent or another equity. In this case, it will be considered as an equity settle plan. And subsequent measurement will be only for the non-marketing vesting conditions for changing in the number of the equipment. Those are required to vest, and there will not be any measurement. So memory hook is no obligation plus equity nature is equity settle, and remaining will be considered as a cash settle. If the entity has obligation to settle and it is not going to issue its own equity, in that case it will exist as a liability in its books. So the group entity that settle the share payment shall equity settle only if the settlement is made using its own equity, and in other cases it will be called cash settle. And in case of intra-group payment arrangement, if one group entity reimburses another group entity for share-based payment provided to employees, such intergroup repayment do not affect the classification. So accounting requirement, the entity who is receiving the goods continue to apply the equity or cash settled based payment plan, and regardless of the reimbursement of the mechanics. For example, a parent grant 200 option each of the 100 employees of its subsidiary conditional upon completion of 2 years. So vesting period is 2 years. The fair value of share option on the grant date is 30. The grant date, the subsidiary estimate at 80% of employees will complete 2 years. And the estimate does not change during the vesting period. At the end of the vesting period, 81 employees complete the required 2 years. The parent does not require the subsidiary to pay for the shares needed to settle the grant of the share. Pass the necessary entries. So in this case, although entity is not paying, but the parent is paying, so it will be considered as a equity settled plan with 2 years obligation. So remuneration expense will be debited for 200 shares, 100 employees, 30 rupees price, and 80% probability. Investing period 2 years, 2,40,000. But at the end of the year, 81 employees opted for the option. So 200 into 81 into 30 and 240 we have already recognized. So remaining expense will be recognized in the books and credited to the equity contribution from the payment. This is all about Ind AS 102. If you have any question, need any clarification regarding this, you may contact on the WhatsApp number given on the screen. Thank you.